We're quite pleased with the overall results. 759 underlying profits and an ROE of around 14%. And there it's still really supported by strong NII, which is up compared to the comparable quarter last year of around 20%. And it's still definitely positive to see good business momentum, both in our corporate loan books, positive trend, net new assets in wealth, but also there you see our mortgage market share increasing to 15%. So also there underlying the mortgage portfolio is increasing. Then we're really focusing on good cost control. So we're also lowering our cost guidance for the full year, although partly is related to delayed investment, as it's difficult to find the right qualified people in a tight labor market. And then, as you said, if you look at impairments, another quarter of releases, and also our impaired ratio is coming down. So that shows underlying credit quality is strong. So this all translates in a very good capital position. On Basel III, Core Tier 1, 15%, and Basel IV around 16%. So overall, we are definitely pleased with the results. And as we said in the previous quarter, we will update the market on our longer-term targets, as well as the capital framework at Q4 in February next year.
So, and again, Ferdinand, that all sounds very good as well. So did you say that apart from the corporate loan book, did you say that there was a bit of an issue there?
No, the corporate loan book is, as I said, the corporate loan book is still growing. And we come out of a period of 3 years of deleveraging with a non-core bank that's near finalized by now. So if you look at the core part of our corporate loan book, despite a challenging environment, it is still growing. So also there we see good business momentum.
Not very often I'm bemused after speaking to someone of your ilk, sir, your seniority, but I just don't understand why are you not seeing any of the effects of all these huge hikes we've seen from the ECB, the historic effects as well? Or do you fear that it's still to come? To take a Jay Powell phrase, the cumulative and lagged effects are still to come?
Yeah, I mean, it's a good question, right? First of all, we look at our net interest income, and a rate environment higher for longer is overall supportive. So you can look at our overall deposit franchise, but overall also the underlying trend on the replicating portfolio and the treasury result is positive. And it's also, if you look at the Dutch economy, which is really important for us, it's doing relatively well. Unemployment is low, below the 4%. Consumer spending is holding up. And also 60% of our loan book is in residential mortgages. And there we've seen that after house price rises of 14% in 2022, the decline from the peak has only been 4%, and you see it stabilizing now. So also there, if you look at the outlook for mortgages, we're quite comfortable there because impairments are mostly related to high unemployment and underwater mortgages. And as I said, unemployment is below 4%. And the loan to value of the overall residential mortgage loan book is below the 60%. So overall there, if you look at the profile of the bank, despite a challenging economic backdrop, we remain confident.